Hi, so we're talking about bank accounts and the term APY. What does that mean? So why do we use banks? Well, for one, if your money is just sitting underneath your mattress, that's probably not a very safe place for your cash. It's safer in a bank, and also along with that, banks provide a huge service. They allow for the easy transference of money in our society. Banks take your money. If you have $1,000 and you deposit it at a bank, they will take that $1,000 and they'll record the transaction to your account. They'll say, hey, this person gave us $1,000, but they don't put that $1,000 into a black box or a vault or anything like that. What they do is they take the money that you give them and they take the money that other people give them, and they more or less create a huge pool of money. And with this pool of money, they then can loan it out to other people. And let's say a person wants to buy a house. A person might not have the $100,000 they need to buy that house, but they can go to the bank and they can get a loan. The bank will give that person $100,000. Now, of course, the person's going to pay the bank back, but the bank's got to get a little something in return for letting that person borrow so much money. And the fee that the bank charges that person for loaning that money is called interest. And so interest often varies. It depends on what the interest rate is. So banks, they pool the money of many people, they keep track of the money that you give them, and then they take your money and they loan it out to others. So, talking about loans, since banks have the advantage of having access to hundreds of people's accounts, they can loan people lots of money, and what they do is they charge interest, and that's how they make their money. Now, let's talk about savings accounts. If you have a savings account with a bank, then the bank should be paying you a little bit of interest. Because let's say you have $1,000 and it's just sitting in that account. Well, it's not really just sitting in that account. The bank is using your money to make money. They're loaning it out to other people and they're charging interest. So you should be getting a little something for letting the bank use your money. And you have the choice. You could go to Bank of America, Citibank, Chase. You could go a lot of places, but the bank should be giving you a little bit of interest because you chose to keep your money with them. And so most savings accounts have an interest rate that is associated with them. So let's say you have $1,000 in your savings account, and let's say your interest rate for that account is 0.3% every month. So you would take 1,000, multiply that by 0.3% or 0.003, and $3 is the amount of interest that you would receive every single month for that account. The FDIC, the Federal Deposit Insurance Corporation. This is run by the government, and if a bank fails, people won't lose all their money. What happened was in the Great Depression, businesses started failing, and people realized, oh my goodness, what if these businesses can't pay back the loans that they owe the banks? Well, the banks might go bankrupt. I need to go to the bank and I need to get my money out of the bank. So there was this huge run on the banks. People were just taking their money out of the banks, and a lot of these banks, they didn't have any money. They couldn't loan it out, and they weren't getting paid by businesses that had loans. So these banks went bankrupt, and there was no safety net. A lot of people who had accounts, they lost their entire life savings. So after the Great Depression, the government said, you know what, we don't want anything like that to ever happen again. There needs to be some type of safety net. So they put a limit. They basically insured a certain amount on every single account. Now, a bank has to be FDIC insured for this to work, but the current limit is $250,000. So if you have $250,000 in a bank account that's FDIC insured, then you will not lose that amount of money in the account. Now, if you have $350,000 in that bank account, the bank goes belly up, then you still get $250,000 back, but you're out $100,000. Let's talk about simple interest. The principal is normally the amount that's loaned out, or the amount that, let's say, you have invested in in a bank account. For the purpose of what we're talking about, we're going to assume the principal is the amount that you put into your bank account, into your savings account. So let's say your principal is $1,000 and your interest rate is 5%. So let's say you're your interest rate is 5% for the year. So how much interest would you have earned by the end of the year? Well, 1,000 times 5% is $50. So you get $50 in interest. All right, compounding interest is when you have a number of periods. It's when you just let your money sit in there and the money starts to compound with the interest that's generated. And here's how this works. You normally have your principal, the rate of interest, and the number of periods. So let's say you put $1,000 into your savings account. The interest rate's 5% and the number of periods is 3. Let's say you do 3 years. All right, so year one, you've got $1,000, multiply that by 5%, you get $50 in interest. So at the end of the year, your bank account has $1,050 in it. So at the beginning of year two, you've got $1,050 in your bank account. You multiply that by 5%, you get $52.50. So you add that to the amount that's already in your bank, and now you have $1,102 in there. So beginning of year three, you take the balance that's in your bank, multiply that by 5%, you get your interest, then you add that. So at the end of 3 years, you're going to have $1,157.63. So this is an example of how interest starts to compound when you just leave money in there, and what happens after multiple periods. So you've got simple interest, which is just the interest that's generated after one period, and you've got compounding interest, which calculates the interest for multiple periods. So APY, what is APY? You often hear about the term APY, on TV, and you'll see banks talking about it. Well, this is your actual return per year. The deal is with most savings accounts, there's not an annual interest rate. Usually savings accounts do things by month. You'll have a monthly interest rate. So if you want to know what your effective interest rate is for the entire year, that's what you're looking for, is the APY. So if a bank says that the APY is, let's say, 5.31%, then if you have $1,000 in that savings account and you just leave it in there and the APY is 5.31%, you multiply that by $1,000 and the interest that you should have earned at the end of the year would be $35.10. So if a bank has, if a savings account has a semi-annual interest rate of 1.5%, that means that you've got 2 periods because we're doing semi-annual. And the interest rate is going to be 1.5% for every single one of those periods. So that means you're going to have 2 periods. Your interest is going to compound. So what would be the APY, the effective interest rate per year? Well, the APY would be 3.0225%. And if you wanted to calculate this the hard way, you could start out with period 1, 1,000 times 1.5% is 15. So add that together. And then you have $1,015. So starting the second period, you take 1,015 times 1.5%, and you get this amount, and then you add that. And so you end up making $30.22 or 23 cents. So this right here is the same thing as this over here, except we were just using the APY to calculate this right here. So the APY is your effective annual interest rate. So what do you need to look for when you're comparing interest rates between banking accounts? Let's say you've got money to put into a savings account. Well, you want to look at the APY, because the higher the APY, the more bang you're going to get for your buck out of that interest.